Before we start today's show, I just wanted to mention our sponsor, Money Farm. Now, Money Farm is a leading digital wealth manager with over 60,000 active investors and over £2 billion invested on its platform. It offers 3 investment products, including a stocks and shares ISA, a general investment account, and a personal pension. And by answering a few simple questions about your investment goals and attitude to risk, you'll be matched to one of 7 globally diversified portfolios. Money Farm's expert team provides hands-on investment management by regularly adjusting and rebalancing your portfolio on your behalf. You'll even get a dedicated investment consultant should you want to widen your investment plan, something that sets it apart from most of its competitors. The minimum investment amount is £500 and fees range between 0.35% and 0.75% a year, depending on the amount you have invested. Money to the Masses listeners can take advantage of a special offer where Money Farm will run your money fee-free for a year. Head to moneytothemasses.com and search Money Farm for more information.
Hello and welcome to episode 339 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, welcome back to the show, and I really mean it this week because obviously you weren't here last week. How are you doing?
It was a great show actually, Andy, because I listened to it and I thought the team did brilliantly. And we've had some great feedback from listeners about the team takeovers, and it's really good. Obviously, for those who missed the previous show, I was moving house this week, so it is always one of the most stressful things you can do. So I was literally mid-move, and the dust is now settling on that move. But as you know, I'm still living with a pile of boxes that are slowly dwindling down. I think some of them will be shoved into the loft or something like that. That probably never ever be reopened, but yeah, it's good to be back to some sense of normality, to be able to do the podcast, because I'm not unpacking boxes or packing boxes.
Well, it's so good to have you back, Damien. And you mentioned feedback there, and the listeners have come good because they've been leaving reviews, and I'm going to read a couple of those out now. So if you are one of the people who left either one of these reviews that I'm going to read, please do email us in, lauren@moneytothemasses.com, claim your review, and we'll be able to send you out a Money to the Masses mug. We will be able to check if it's you, so no cheeky ones. And so the first one says, excellent podcast. I've been listening to Money to the Masses in the past year or so, and I've found it an excellent resource to continue my financial education. The format of the podcast is great and covers a wide range of topics, which I wouldn't have even considered looking into. I find myself listening to these during my morning runs. I wish I'd started listening to these podcasts 300 episodes ago. Keep up the good work. And the next one is from 49 Cent, and it says, very informative, really good podcast covering a wide variety of issues and subjects, easy to listen to, and a good balance of subjects covered with some top-notch analysis. So thanks again for those 2 reviews. We have had more. We will read more out on the podcast as the weeks go forward. So please do keep sending those reviews in. You know the score. It really helps us out because it helps us move up those rankings, and we reward you guys with our coveted Money to the Masses mugs. And as I say, get in touch if they're yours, and we'll be sending those out in the next week.
And those reviews are incredibly motivating. So what I'm going to do now, Andy, I'm going to tell you what's on the podcast, because I've come back and I think I've kind of overdone it. There's quite a bit to get through on the podcast this week. So the 3 pieces I'm going to do, one of them is an investment piece on the cheapest stock markets and sectors out there. This was inspired by an 80/20 investor piece of research that I did this week. I'm often asked whether markets are expensive or not, and whether that means they're bad value or not to buy. This touches upon that topic and provides some answers. The next piece I'm going to do is broadly classed as a pension tax trap, but it's more than that. It's a tax trap that can impact anybody who is not just taking out their pension, but somebody who may be much younger, who might be changing jobs or getting a bonus. So there's a tax trap you want to be aware of. And the final piece on the podcast is about bonus sacrifice. Now, you may have heard of salary sacrifice. Don't worry if you haven't. I'll give you a brief explain of what that is. But bonus sacrifice is something slightly different that I want to cover on the podcast.
Okay, so let's start with the main investing piece. And you've been doing some analysis, crunching some numbers as you normally do for 80/20, and you're going to reveal some of that insight in today's pod.
Yeah, so on the question of whether markets are expensive, so people will sometimes look at markets and look at how high they are, because they are still, relatively speaking, near all-time highs or multi-year highs, and they wonder whether that actually means that's a good time or bad time to buy the stock market. And of course, that's $1 million question. One way you can try and discern that is to look at value. Does something represent good value for money? It's a bit like a house. The housing market, if you were going to buy a property, is it good value, or will there be some kind of correction in prices along the way? So with stock markets, how do you discern value, whether something is good value or not? Now, interestingly, there are different measures, but one is the price to earnings ratio. So you look at the price compared to the earnings per share of a particular stock or company. So that means, in simple terms, if the price is high, so the amount you pay for a share, compared to the earnings that company generates per share, so it's a ratio, then that would make it expensive. It's a bit like you're overpaying for what the company's actually producing in terms of earnings. So the lower that number, then that would obviously appear cheaper or better value. But what you do is you look at that PE ratio in comparison to other stocks and companies within the sector or similar companies. So you can actually therefore start to get a relative interpretation of whether a company represents an expensive stock or a cheap stock. It's good value for money. But of course, value investing is inherently difficult, and there are traps. Some things are cheap for a reason, and they actually get cheaper along the way. But obviously, if you look at a point in time, there is a drawback with PE ratios, because as economic cycles change and flex, then the earnings of a company can change considerably because of the sector they may be in. For example, they may be producing oil or gas, and if the economy is booming, then they will obviously earn more money, then it will impact their PE ratios. Equally, stock markets do rally and fall, so the prices go up and down. So that ratio at any given moment of time can be slightly misleading and can fluctuate quite a bit if you just base your decisions on that one PE ratio. But one alternative measure is something called CAPE. And I've touched upon it before in the podcast, CAPE, and it's called the Cyclically Adjusted Price Earnings Ratio. So this was a ratio that was popularized by Nobel Prize winning economist Robert Shiller. And what it does, it smooths out the variations due to the economic cycles. And effectively, it looks at the price compared to the earnings per share over a 10-year period. So it's a 10-year average of inflation-adjusted earnings per share. So straight away, you can visualize that that's going to give you something that's going to knock out those variations and give you something that's a bit more reliable. Now, what you would need to do is compare it to its long-term average, because if you're looking at the CAPE over periods of time, then that CAPE will change, won't it? So it's kind of like a rolling measure. But you can look at the long-term average of a particular stock's CAPE, compare where it is now, and therefore you could say, well, let's give it a number. It was 16 as the long-term average, and it's trading at 18. Then you know that it's expensive compared to the long-term average. And the idea being that over time, then there is a reversion towards that mean. If something is very cheap, then it might represent good value. The rest of the world might catch up with the idea that this is a good value stock, and they might actually buy it, and then it will revert back to that mean. Equally, if something's expensive, then people might deem it expensive, sell it along the way. Fundamentals catch up and it reverts back to mean. That's the kind of idea. And the reason it became quite popular is because Robert Shiller effectively predicted the market crash in the late 1990s using this method, because you can use it on wider indices. It doesn't have to be a stock by stock or company by company measure. You can use it for like the US stock market, for example, or the UK stock market as a whole. You can derive a CAPE ratio. And by doing so, he said the market was expensive. It was due a correction to come back towards its mean. And that's effectively what happened. So people use it sometimes as a measure to see if we're going to get a market crash. Now, there are pros to it. It's easy to apply and understand. The cons are that it's not necessarily easy to calculate or find the data. In fact, if you try to calculate it, almost certainly that nobody who listens to this podcast will be able to, unless you've got a background in economics. And the other thing that's a negative of it is that it's not foolproof, but it does give you some information about whether something is expensive or not. Now, as evidence of the fact that it's not foolproof is 2 years ago, I looked at how expensive stock markets were, and the US stock market then was trading with a CAPE ratio of 27.74. Now, the long-term average is 16. So you can see it was massively expensive, because normally they only fluctuate around their median. It's not normally so extreme. Well, that would suggest that we were going to get a pullback. And, well, we know what happened. We did get a pullback because of the pandemic, but markets have kept pushing higher and higher, and we're near all-time highs. And if you look at the CAPE ratio for the US stock market now, so looking at the S&P 500, then it's 38.7. So it's even more expensive, and it's actually more expensive than almost it's ever been. So just because something is expensive doesn't mean it won't go higher. So it's not foolproof, but it is useful. So if you want to use it as a bit of information, maybe alongside your own views on investing, so looking for those opportunities, maybe it be momentum investing, whatever you use to build a portfolio, CAPE, I think, is probably one of the ones that I like in terms of valuation metrics because it's very easy to apply. And I'm going to give people some insight into particular areas that are cheap or expensive. So if you look at developed world equities compared to where they were 2 years ago, they are all broadly more expensive than they were. And that means on a CAPE ratio, I'm not just talking about price, I'm talking about looking at their long-term averages, Europe as well. If you strip out the US and Canada and you look at the EAFE region, which is broadly Europe, Australasia and the Far East, that is based on history, good value. So it's below its long-term average in terms of CAPE ratio, which means it's good value for money. And emerging markets are too, but they're almost at par values. They're almost hitting their long-term average. So that means that questionably people might say, is there a lot more upside? You'd have to wait and see. But what you can do, you can use CAPE to look at countries as a whole. And so broadly speaking, if you look at countries across the world, I'm talking about Australia, Brazil, Canada, all the way down through Poland, South Korea, UK, US. I mean, we looked at all the different countries, and as a whole they are all more expensive than they were 2 years ago. Now, interestingly, there were very few places that became cheaper and actually became classed as good value, i.e. cheap. They were traded below their long-term average, and they were China, Hong Kong and the UK. So the UK stock market is actually now trading below its long-term CAPE average. So it's class as being cheap, good value for money. So that will be interesting for some people who might buy into UK equities thinking that actually they're cheap and there could be a mean reversion, and compared to, say, US tech companies, which are incredibly expensive based on most measures, including CAPE. Now, why is the UK cheap? Partly because of the lack of technology stocks in the UK indices. It's got quite a significant exposure to things like oil and gas, but also Brexit hit it. And if you look at the pandemic recovery and look at the main indices in the UK, they've not recovered to the same extent as what we saw in other countries. And what I like about CAPE, it does smooth out some of the stuff we've seen in the pandemic, because obviously earnings have been hit massively in the last year, share prices have fluctuated, but what we've seen with a 10-year average, it means that the CAPE is slightly smoothed out and therefore a useful measure. But as a sector basis, if you look at the US, for example, there are 11 sectors we looked at, and 8 of them are classed as expensive, with only 3 are below their long-term median, so i.e. are cheap, and they include cyclical sectors. So they are things that would have been economically sensitive, which probably did take a bit of a hit as a result of the pandemic. But expensive is technology stocks, are eye-wateringly so. And now if you're Robert Schiller, you'll probably think there's going to be some correction at some point in the future. But as I've pointed out, it's not fail-safe. It is a useful piece of additional information that's out there. So take away from this podcast, if you're looking for a value metric that is interesting, then consider CAPE. And right now, slightly dating the podcast, I've mentioned a couple of areas there that are relatively cheap, including the UK.
That's interesting stuff. One thing that sort of came to mind for me was looking at that research. Was there anything that was deemed cheap, say, a year or two ago that is now sort of expensive?
Yeah, I mean, there are a couple of areas, but one in particular, which I will tell podcast listeners, you can read the research for free if you have a free trial of 80/20 Investor. But German stocks were cheap 2 years ago, but they are now classed as moving above their long-term average as expensive. So European equities were cheap generally 2 years ago, but they have seen an increase in their current CAPE measure. So they are now no longer cheap opportunities.
Okay, so moving on to tax then, we're going to be talking specifically about this pension tax trap. It's not really that. You're going to explain more, Damien, but it's more a broader piece on tax and understanding how it works.
Yeah, so in the Times, I think it was last week, there was a piece about a pension tax trap, and it's slightly scaremongering, but it was actually quite an interesting piece, really. And it was talking about a chap who retired, had a pension, so he had a SIP, which would have been in drawdown. He took his full tax-free cash. If you want to understand how that works in terms of drawdown, then go back to podcast 271, where we talk about the options under drawdown, how you can take your pension over time. But what he did, he took his 25% tax-free cash lump sum when he retired, and then he decided to keep the remainder invested, and he was going to derive income using that. going forward. And the way he decided to take that income was as lump sums every year. So he would take one-off lump sums of £25,000 every year and use that to live off. And he would then leave the rest of the pot invested. So he wasn't taking monthly withdrawals, which a lot of people, and probably most people do. He was taking the lump sum each year and using that money outside of his pension to live off, which is up to him. It's his prerogative to do so. The problem occurred is when he started getting his tax and actually the money that he received net of that tax, because he was getting hit by what is effectively an emergency tax rate. So he paid an additional £5,000 extra tax a year as a result of him taking his pension annually. Now, this is a quirk of the system, effectively, of the pension system and the taxation system that occurs that people need to be aware of. So there will be plenty of people who may be going to be nearing retirement who want to take money out of their pension in excess of their tax-free lump sum, or they may have parents who are going to do so. They may look at the amount of money that's going to come out and they might know their tax position and think, if I take out £20,000, it's taxable. Yes, they've got their personal tax allowance they can put against it. They work out what they think their tax bill will be and how much they'll be left with, and then they'll have a nasty shock because they have a lot less. What happens is if you take a lump sum from a pension that is taxable, then you effectively get put on a special tax code called a month one tax code. It's effectively an emergency rate tax, because you've got to think what happens with taxation is that if you have multiple pensions, you can have multiple tax codes for those pensions. What happens is HMRC doesn't know how much tax you're going to pay. So when you end up drawing the money out of that pension pot, they think, well, he's going to be earning £25,000 a month for the next year. So they applied taxation according to that assumption, to which is this emergency rate. So effectively, he was getting taxed at 40%. The problem is that this is impacting 30 to 40,000 people a year who are drawing lump sums from their pension and not realising it. And apparently nearly £750 million has been overpaid in tax since 2015 when pension freedoms came in. So in this guy's particular example, he got less money from his pension net, so he had to then draw money from another pension to try and make up the shortfall. And typically what he would do is he had been using his self-assessment, which can be up to almost 18 months later, because it's not the January of the year you've taken the money in, it'll be the one after that you end up filling out a tax return and then can reclaim the overpaid tax. So you will get it back. I mean, this is the point I want to put out there. It isn't a tax trap in terms of you lose the money forever. It's an annoyance because of the way the tax system works. And just to deviate slightly before I come on to like how you can mitigate this is something that, I mean, Andy be well aware of in terms of being in accounts before his days at Money to the Masses and doing payroll. Because if you change jobs or you get a bonus at work, you can be hit by an emergency tax code, can't you? And pay a higher rate of tax than you thought you would have done.
Yeah, absolutely. It's something that people just need to be aware of in those situations, whether you're changing jobs or getting a large bonus. Because if you think about it from HMRC's point of view, they are trying to ensure that you don't get into a situation where you either owe them lots of money or they owe you lots of money. So there's certain assumptions that they will make. And the only way they can really make this fair for everyone is by doing it on a month by month basis. So what they do is they look at your situation that month, they take a snapshot of it, and then they act accordingly. So let's look at a scenario where you're changing jobs. The first thing that they will do is they want to understand what you've earned before the job that you're going to. And generally the way they will do that is they would like to see a P45 form. Now that P45 will list your previous job, where you worked, and how much you earned. Now, if your current employer that you moved to has access to your previous P45, that makes things really simple and really easy. Your new employer will input the information, tell HMRC exactly what's going on, and they can go, right, we'll switch you straight on to the correct tax code. And in that situation, you won't have any problems. Where it does become a problem is when there's a delay with that P45 being issued. But here's the point, and it's quite important to make. You can actually do something about it so that you don't go on to this week one, month one emergency tax code where you get automatically stung for a higher tax rate. What you'll need to do is you'll need to fill in a P46 form. It's a simple form, and to be honest, most new employers should know about this system and should be actually contacting you to let you know that you'll need to fill this in. But it is your responsibility the employer can't do it on your behalf. It's a simple form that effectively you tick a few boxes to say whether you've got another job, whether you're simply moving from one job to another, and it enables HMRC to understand the situation in lieu of receiving the official P45, if you like.
So just to be clear, that P45 tells HMRC how much you earned in this tax year, the tax year that you've left at your previous job. So then when you start your new job, they know, right, okay, they can tax you accordingly. They're not going to start on this emergency tax code. So that's why when you leave a job, you really need to leave and get that P45, because you don't want to go to your next job without it, really, because if you do and you don't use the P46 route, Andy said, you're going to get a lower net pay, because we're talking about people who are employed here, who are getting paid under PAYE. You'll get a lower first pay packet, which is a bit of a sickener when you probably move jobs to earn more money and you can find you actually net pay in your first month is lower than what you were getting in the old job where you actually earn less money generally.
Yeah. And if you think about it from HMRC's point of view, they have no idea that you've moved from one job to another. They're just seeing another lot of money hit the account, if you like. I mean, there's nothing stopping a lot of people from having two jobs, for example. So they would perhaps assume that you're still working the old job and the new job, in which case this is why they think, oh, we'll just put you on this emergency code until things can sort itself through. So always make sure you fill in one of those P46 forms when you move to a new job if you haven't got a P45. But the ideal scenario before you move on jobs is just speak to your current employer and just say, look, can I have my P45 on the day that I leave? Most employers will be able to sort that out for you. There is another situation in your current job. Again, we're talking about PAYE here, and it's for people who receive regular bonuses or fluctuations in pay, and that will be often because of commissions or performance related pay. In these scenarios, you are going to have some tricky situations with tax and the amount of tax that you pay fluctuating. Now, just to explain that again, it's very similar to the situation we've explained before where HMRC are working on a month by month basis. It's the only real way that they can keep on track of things and to ensure that you don't have a big lot to pay at the end of the tax year or similarly have to claim back a big lot. So let's use a scenario. Let's say you earn £36,000 a year. That's £3,000 a month gross. When you run it through the calculations, and you can do this online, there's lots of calculators out there that will run the numbers through for you. If you earn £36,000 a year, that's £3,000 gross a month. You'll pay roughly in the region of £400 a month tax. If you were to receive a £2,000 bonus in that month, that tax would actually jump up from £400 to £950 in a month. Now that doesn't really stack up. The reason it doesn't is because what HMRC are doing is they're looking at your gross for that month and assuming that your new salary is actually £60,000. And of course, £60,000, when you look at the thresholds, pushes you well into that 40% tax bracket for the upper end of what you're being paid. But all is not lost, because what will happen is the following month, when your pay reduces back down to the standard, let's say in this scenario, £3,000 a month, they will look back at the previous month and check and see where we're at. And the way that the tax system works, most employers use a system called real-time information. It will constantly check and amend what's been paid in the previous month. So in this scenario, you would probably overpay about £150 tax on your bonus in that month, but the following month it would redress and you should see £150 coming back. You won't see it as £150 credit. What you'll see is overall, compared to 2 months ago when you got the £3,000 and you're expecting £400 tax, you'll get roughly £250 tax that month because it's redressing. Does that kind of make sense?
Yeah, it does. So as it rolls out, they're multiplying up how much you've earned so far in this given tax year, and they start to work out your taxation, and it therefore keeps fluctuating back and forth until at some point you should hopefully get to the end of the year and you've paid the right amount of tax. So this is something that everybody will probably ever have found at some point if they've got a bonus. So if you've got a large bonus in the past, especially if it's the start of a tax year, that's a difficult time to get a bonus because you normally get quite hammered with tax when you first get it. But also if you get bonuses at Christmas, if anybody's hoping for one, don't just think it's like applied 20% or whatever to that bonus and that's what you're going to get net pay. It probably won't be, as Andy explained. You'll probably be taxed a little bit more, then it will rectify itself via PAYE in the coming months. But going back to the pension point, You don't have to wait until your self-assessment to get the money back, which is what a lot of people don't realise, because you can get a refund if you withdraw the money from the pension and you get an emergency tax code. You can get a refund within 30 days because there are 3 forms you can use. There's a P50Z, which is for people who have drawn all of their pension pot with no other income coming in. There's a P55, which is for people who've taken part of their pension and intend to take further payments, and a P53Z, which is where people have taken all their pension, but they have other income. Basically, those 3 forms enable you to be able to get a reclaim of the tax, the emergency tax that you paid on that large pension withdrawal within 30 days. So you just have to find out which one suits your circumstances. So speak to HMRC if you're not sure. The message is you should get it back eventually. The key thing is you want to try and get it back sooner rather than later. Other odd things you can do, bizarrely, because of the way the system works, you could in theory take a small amount from your pension pot. So this guy could have taken, say, £5-10 from his pension pot. He would have had an emergency tax code probably applied on a smaller sum of money, which he could then have told HMRC that that's the wrong tax code and get it rectified, and then take a larger amount, because he would have avoided a large tax bill on the very significant sum of money by splitting it down. So you could do it that way round. Again, if you've just retired and you've got a P45 from that job, then you want to make sure that your pension provider gets that you speak ahead of time and you ensure that when the payments are made, that things tally up. So the message is, don't be passive in this. If you're starting a new job, make sure you're talking to your new employer that I don't want to pay emergency tax on this, and they go and do the things they need to do to ensure that you don't. So it doesn't have to be overcomplicated, but make sure you just are paying the right amount of tax, because the emergency tax code, we've all probably experienced it at some point. Probably most people not really understood why, but it is something you can avoid.
Okay, and so for the final piece of the podcast then, salary sacrifice is something most of us have heard of, but bonus sacrifice is something that you're going to concentrate on here and explain.
Yeah, so go back to podcast 85, which was a long time ago, different theme music. It's about the first, I think, ever theme music we've had. We've had about 3 or 4 since then. And I talked about salary sacrifice and explained what it was. And in simple terms, it's the ability, say you're employed and you're earning money and being taxed under PAYE. PAYE is pay as you earn, in case anyone doesn't know, but basically it's the taxation system. You can actually give up some of your salary in exchange for, say, a pension contribution. And people might think, why would I do that? And the answer is because there's generally a tax benefit for doing so. Now, go back and listen to that episode. I'm not going to go over everything because, as I say, you can listen to it in that particular show. But the positives are it can mean that you can increase your pension contributions. To give you an example, let's say somebody was earning £40,000 a year and they were paying 5% pension contributions into their company scheme. Their employer was matching that with 5%. They get £2,000 after tax relief that they've paid in to the employer's pension scheme. The employer pays in £2,000. And of course, then when you factor in their earnings and how much taxation they've paid, including national insurance, their take-home pay would be £29,262 in a year, but they would have £4,000 added to a pension, which takes the total benefit to them to £33,262. Now, don't worry about all the numbers. I just want to use it to illustrate a point, because if instead they decided to give up some of their salary, so they took a slightly lower salary, hence the word salary sacrifice, your employer has to have such a scheme. More of them do allow it because there is a benefit to the employer, which I'll come on to in a second. But if they sacrificed £2,353 of their salary, then effectively that's the equivalent of that net contribution after tax when you're talking about tax and national insurance that would have been £1,600. In the round, all that you've got to focus on is that if they sacrifice just over £2,000 of their salary, then at the end of the year, they would have received £29,262, which is exactly the same take-home pay, but instead their pension contributions would have been £2,000 from the employer and £2,353 from them, because you don't pay national insurance on sacrificed salary. So that difference, that boost, is effectively the 12% national insurance saving that they make on the bit of salary that they've sacrificed, if that makes sense. So all you've got to realise is that you can have a slightly reduced salary in exchange, for example, higher pension contributions. It works out to be your overall benefit in this example I had was 33,615. So they were better off doing that. The thing is, it can mean that if you've got child benefit, for example, where if you earn over £50,000, you're going to start to lose your child benefit, that you could do salary sacrifice to get your salary under that threshold and get the money paid into a pension, and you'd be net better off. You won't have lost child benefit, but you'll also benefit from the national insurance contribution saving into your pension. The other thing to just quickly throw in there before I go on to what bonus sacrifice is that because the employer doesn't have to pay national insurance on the sacrifice salary as well, then that can mean that they can save up to 13.8%, which if they want to, they can just keep that saving, which is why they quite like the salary sacrifice idea. But they can also give it to the employees if they agree, or some of that, to boost their pension contributions even further. So there are people who will do that. Now, for high earners, the amount of national insurance saving you get above £50,270, it's only a 2% national insurance contribution. So the saving and benefit on the bit above that isn't so great, therefore doesn't boost your pension as much. But the point is, salary sacrifice can be incredibly useful. And I think it's going to become more popular as a result of the increase in national insurance that's been announced. It's going to be an extra 1.25% next year. That's going to be a burden for employees and employers. Now, I've not heard of anything yet to stop salary sacrifice or anything like being used to mitigate that tax, but it means there could be a bigger saving effectively for people going forward. So I wouldn't be surprised if we start hearing more about salary sacrifice. But what is bonus sacrifice? Very simply, it works in a similar way. The taxation principle is identical. You could give up a bonus and say, for example, have it put into your pension instead, and you could benefit from the national insurance savings and it could boost your pension. Now, one thing I want to point out, there are two types of bonuses out there. There's contractual ones that you are in your contract going to get at specified points in time, and there's non-contractual ones which are generally just like Brucey bonuses you're given ad hoc that you aren't promised. Now, if you've got a contractual one that is specified that's going to happen in your employment contract, if you want to sacrifice that, then you have to have your employment contract changed or updated to allow for that to happen. If it's an ad hoc one, then you could go and speak to your employer's payroll department and arrange to sacrifice your bonus and maybe put it into your pension, which you could then benefit from that actual bonus and saving from national insurance, as can your employer. So you could go and negotiate that. That could be much more ad hoc. They don't have to put anything in writing, but they might want to, just to confirm what went on. But the reason why I also mentioned it is because there will be people out there, and I know people personally who've done this, who have used a bonus sacrifice method to avoid losing child benefit or to avoid losing their personal allowance. Because when you earn over £100,000, then your personal tax allowance is tapered by £1 for every £2 of what they call adjusted net income above that £100,000 threshold. And pension contributions are a way of reducing that adjusted net income. So say they were earning £60,000 and there was something amazing that happened at work and they got a 50 grand bonus. It does happen to some people. Then they could actually use that and put that into their pension. They can benefit from that, not lose their personal allowance. Basically, taxation, it's better. So that is something that people will want to use bonus sacrifice for. Again, employers also save on national insurance, so there are negotiation points there. But there are drawbacks to it, as there are drawbacks to salary sacrifice. I mean, salary sacrifice, for example, let's say, I mentioned it in episode 85, but if your employer's got, say, a death in service benefit scheme, which means if you die, life insurance pays out that's linked to your salary. If you reduce your salary through salary sacrifice, your life insurance drops. Also, it can impact your benefits you're entitled to, your potential maternity pay, or indeed the mortgage amount you can borrow in the future. So it's something to bear in mind. Similarly, there are drawbacks for bonus sacrifice. So once it's been agreed, if it's contractual, then it might be difficult to revert your package back to what you had before if you decide that you want to in the future. It again can limit your ability to borrow money in the future in the same way as salary sacrifice, because don't forget, Bonuses can be included in mortgage affordability calculations. Very high earners might be caught by tapered annual allowance trap. Now, that relates to your ability to pay £40,000 into a pension, because there's some technicalities, but for very high earners, there is something called your adjusted income. And if it's above £240,000 and something called your threshold income, don't get bogged down. You can search the tapered annual allowance trap if you want, if this impacts you. But if your threshold income is above £200,000, then your annual allowance for your pension contributions is reduced by £1 for every £2 of excess adjusted income. What that means is that contributions to pensions paid by salary sacrifice don't reduce your threshold income in the same way as if you made the contributions yourself as personal pension contributions. So the point is, if you are a high earner and you're going to start using bonus sacrifice, you should get financial advice, because there could be something in it that you could shoot yourself in the foot. Again, just like salary sacrifice, it may reduce the benefits you are entitled to. And interestingly, we talked, I can't remember which podcast we were on, but low earners, there is a position where non-taxpayers are better off paying personal pension contributions because they get the 20% tax relief themselves. Now, if you do it via salary sacrifice, you're effectively just taking a reduction in your salary, as there is no tax benefit in doing so. And if you earn below £9,568 in the current tax year, then you wouldn't benefit from a national insurance contribution savings if you sacrificed salary or bonus. So basically, if you're earning below about £12,500, you really should start thinking whether you'd even want to be involved in a salary sacrifice scheme of any kind. So they are the drawbacks. But overall, it's something for people to think about as they approach Christmas, if they are lucky enough to get a bonus and they decide that they don't actually want to take it.
Great. So that's it. We're done for this week. If you want to contact Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. We're in the usual places as well. Instagram, TikTok. Don't forget about TikTok. And of course, you can head over to YouTube and search for Money to the Masses. We're putting a lot more videos out on YouTube at the moment. And if you can, please review the podcast. It'll be very much appreciated. And so, Damien, that's it. We're done for this week.
Yep. Until next time.
Until next time.